Okay. Hi, I'm Peter Rose, founder of Longwood Currency Trading. How I maximize my Forex exit profits. That's kind of the topic I'd like to cover today, and there are three areas where this comes into consideration, or I found that it comes into consideration in my trading anyway. And again, you have to remember I'm trading large lot size, and so it complicates the thing over the situation that you might find if you were an all-in, all-out trader, trade many sort of 3 or 4 or 5 lots positions. Basically, the three areas of concern that I want to discuss is the entry analysis stage, where we're getting into the position, the section of the trade cycle where we're building that position and maybe even getting into staging in some of it, and the third area has to do with a runner that is screaming along, and you're either continuing to stage into that or you're just watching it for an exit. And so those are the three areas that I'd like to cover in this. Well, the reason that was brought up to me was because I'm out here today. I wanted to bring in some wood for the wood stove. It's going to be down in the low 40s or high 30s tonight. This is early November of 2023 in New England, US, and so you can see it's kind of a gray day in New England. The reason that I came to this topic today was because I was out here stacking, bringing wood in the cart, and you can see this section here. This whole thing collapsed on me. I was only out here about a little bit, and then the whole back 2 stacked rows just went and I'm standing there with a pile of wood around my legs going, well, this is going to take a while to clean up. So how would that impact my trading thoughts, and I mean, what does that have to do with exit methodology? Well, exit methodology is not something that you plan. You can't plan when you're going to get out when you're trading large lots. If you're all in, all out, then you're setting your entry point, and you're setting your stop, and you're setting your profit target, and you just set and forget and let it run. But once you get into building positions and staging them in, then that process changes a little bit. It becomes more dynamic, and there are more things that can go wrong. More things that go wrong than right, I guess is what I'm saying. And so here I'm out here pulling this wood in for the wood stove, and all the wood comes falling down. And I thought, isn't that correlated to what I experienced just this last week in exiting a position where an unexpected series of events occurred, and I thought, oh, I've got to get out of here. I've got to get out of this position. The thing isn't going well. Now, this was a position that was into the position management stage. I didn't have a runner. I was just building the position and moving it forward. But like they say, shit happens, and you're paying attention to it, and you have to be able to react to that just the same way I had to react to the wood pile. I'm pulling wood off the wood pile and loaded it into the cart to bring it in here to the porch to stack it in here. Let's show you the results of my efforts today. And there they are. And so that was the plan. That was my trading plan for that particular task. And it was interrupted in the fact that all of a sudden I've got a pile of wood all around my legs. Now what do I do? And so you had to work my way out of that. So you're in a position, and you have a trade going, whether it's in the entry or position management, or whether you're chasing a runner, it's all the same. You have to be aware of what's going on with price action at any given time in order to determine whether you're going to let the thing continue to go, or whether you're going to cut and get out. And that's, I mean, you don't have those decisions to make if you're all in, all out, right? You set your 20 pip stop, your 10 pip stop, or whatever you're comfortable with. It hits 10 pips, and you go out and you lose 500 bucks or whatever size position that you're trading. But once you're trading multiple lots, you might go in with 3 lots, take a 10 pip hit to $300. If it goes in your direction, that 3-lot position, you might pop another 3 right away and another 3 after that. Then you might build on top of that. You might go and position all the time is gyrating all over the place. And, you know, the more you load on to that position, as I've said many times in these videos, the closer your average price comes to the current price. And I mean, I'm not going to draw a chart for you. If you can't visualize this stuff, some guy was complaining at me because I don't show any charts or anything. What a moron. Jesus Christ. You know, part of trading is visualization. If you're trying to do a system, then you've got to look at the charts and see what some guy's going to do with his engulfing candle fucking pattern. Okay? But when you're trading, it's a whole different ball game. And I'm sorry that some guy trades many lots or doesn't know what he's doing. Is getting all incensed and leaving stupid comments on the video because he doesn't get it. He doesn't understand trading. So when you're getting and trading small lot positions and you're going all in, all out, you set your stop and you're out. You set your profit target and you're out. When you get to a certain level, you may want to bring that stop up and trail it a little bit. It's simple. It's really simple to do. But once you start breaking that position up into multiple trades, multiple transactions to increase the size of your position, you've got a whole different basket of events that could happen. And your rules, in order to keep them simple, need to be extensible to cover those different situations. You can't have a set of rules when you're trading multiple lots, and a set of rules when you're in out, and a set of rules when you chop, and a set of rules when you're in a trend, and you get a set of rules for going short, and a set of, you can't do that. If you have 2 rules, you have 4 permutations you can put those rules into. If you have 3 rules, you have 21 permutations you can put the rules into. How many fucking rules do you want to have? You have to be very careful about how you're putting your trading plan together and how you're building those rules so that they work for you and you don't have to concern yourself with, oh my God, what am I going to do here? The situations that we're going to cover again are at entry, during the building stage as you're adding into the position, and then when you get a runner. So I'm going to go inside because my coffee's inside and it got cold because I just got done restacking that wood, and I want to go inside and have some coffee. So let's go do that. Okay. All right. Got my coffee. I had to warm it up. It was cold. In discussing how to maximize your profit, you have to be able to look at the problem that you're trying to solve to see where the points are within the life cycle of a currency position, as I've defined it as entry analysis, position management, and exit methodology. You're taking a very complex system, and you need to break that down into manageable pieces and have rules for each one of those pieces, simple rules. That simplifies the trading process. If you're not doing that, you might want to consider re-looking at your trading plan and how you're solving these problems. But regardless of that, there are those 3 phases, as I said, in a position as you're going through. You have the problems that are dealing with entry analysis. Not only dealing with the entry as you're going in, but also exiting to get out. Now, if you're an all-in, all-out trader, if you're just getting started in this stuff and you're trading less than 4 or 5 lots, you should just be all-in, all-out. You have a 3-lot, full lot capability. You go all in with 3 and you come all out with 3. You have no complexities. You set your entry point, you have a stop, and you have a profit target, and you just play the gear like that. There is some exit theory in there that I could talk about, but I don't teach beginners, and so it doesn't make any sense to really load in and specifically address this stuff at the smaller lot size positions. I teach folks that have those 3 to 5 lot so positions, and a low to mid five-figure account to support that, and not trading at 200 to 1. I can't help anybody that's trading at 200 to 1. Don't send me an email. But they're struggling to improve their trading. What does that mean? The only way you're going to be able to improve your trading is by looking at the metrics that you've done in a real account, not in demo or something, but in a real account, real live money, and not trading minis where the money doesn't count. I mean, what are you going to do? You're going to get your bowels in an uproar because you lost a pizza for the day? Come on. At a buck a point? No. Even 3 minis, that's not going to change your lifestyle. Trading one full lot's not going to change your lifestyle. Are there people that can take one full lot, $10,000, let's say, a funded account, because you got a $6,000 mortgage margin that you have to hit, so you got $4,000 of runway you want to run, so you got a $10,000 account to trade one full lot. You're going to think you're going to change your lifestyle by trading one full lot. You get some fool out there teaching you that you can, or saying that you can. He's trading at 200 to 1. He's got 5 years experience, and he's telling you that you do this by Bollinger Bands and RSI. He's full of shit. And Fibonacci's and all the rest of the crap that's out there. He doesn't know how to teach you how to trade. And so he talks about Fibonacci's and crap like that. But that's not how he really trades. That's not how he says, oh, I'm going to get out of this trade here. I'm going to do this at that particular time. So I'm trying to help you unscramble yourself from all this information that's out there and try to simplify the trading process and identify where you're going to be running into problems and how to solve those problems. So the problem we're talking about today is, how do you exit a trade? Well, where are you most likely going to be faced with exiting a trade? You're going to exit it at the entry, where you're putting the trade on, or whether it's going to hit your stop, or whether you're going to get out sooner, or whether you're going to add to that position in a negative balance and go from there. But there's entry questions that you need to have in your rules that have answers, so that if things don't go your way, you know what you're supposed to do. If you're trading small lot sizes, all you need to do is wait until your stop gets hit and you're done. You don't have to get your balls in an uproar over it. If you're trading 20 lots, like I do, at this particular time, like I said, we're in 2023. The problem complicates itself simply because you have more moving pieces now. You're not going to go in with 20 lots and come out with 20 lots, because if you get a 10 pip hit against 20 lots, you're at $2,000 hit. And if statistically, if you're an active trader, you're going to hit 6 full losses in a row. You'll be $12,000 down in a worst case scenario. So do you want to do that? So that's where the building of a position and staging and all that other stuff come in. So you have that next phase. You come out of entry with all in, all out, and you come out of entry in breaking the position down into building and staging and all that other kind of stuff. So that's the second area that you're going to be dealing with in determining what's your lot size. Let's say you've got an 8-lot position and you've been working with me for a while. So yeah, you should probably be staging and building your positions at this time. 8 lots, you can really start to do that. Anything under 8 lots, you really can't. I mean, what are you going to do? You're going with 2, and you're going to go in with 2 more, and you're going to go in with 2 more, and you're not maximizing things with a 5-lotter or something like that. By breaking out, you need to go in with 5 and come out with 5 at 10 and make $500. That's what you need to do. But once you get up around 20 lots, you don't want to go all in with the 20. So you're building. Now you're going into the build stage. You've made your entry, but now you're going to add to that position. So that brings on another characteristic, because every time you add to that position, you bring the average price of your position closer to the current price. That's just basic math, right? And so that brings in, where do you set your stop then? Or how far do you let your price go? What's the indication that you have that price is faltering and you are statistically better off exiting the position at that time and taking whatever little profit that you could get at that time. Maybe you only got 2 pips because of the averaging of the position, and you get price. You were 5 pips current price, 5 pips away from the average price, and it's come down 3 pips. So you got 2 pips left to go. You've got let's say you get 5 pips on, and so 2 pips is you make $100. So you get out. Price continues on down. It validates it. It would have gone taking you negative. And maybe you got out at that 2 pip point, and there was a bounce, and it went back in your direction, and you goes, oh shit. Well, you got to look at that. How big is your bank in relationship to the risks that you're taking? You know, I can have positions where I can risk $4,000, $8,000, $10,000 and I'll run in loss because I'm dealing with a large account, and that from a percentage standpoint, that is, it just isn't a percentage against the bank. It's based on a process of where the price is in relationship to where you got in and where you're trying to get to, and how far it's gone out of sync, and what the big picture looks like. But that's trading. That's why a lot of the folks that listen to my channel are going to complain about what I'm telling them, because they don't get it. They don't get the difference, because they're trading fucking mini lots. For those of you that are serious traders and you're getting jammed up with your stuff, this is the stuff that you're going to face. You can't start implementing the solutions now because your account isn't big enough to do that. But you have to be aware of it. Just like if you're on a trail, and I could point out the ruts in the trail here and say, you know, when you get further down the trail, there's a washout there because of the rains and stuff, and you've got ice and you've got all this other kind of crap going on. You don't see that now because you haven't done that before, but you can kind of visualize that things are going to get a little bit more complicated further down the trail, and so I better pay attention right now to how I deal with this, so that I'll be better prepared when I see this other stuff come up, how to deal with that. That's how you solve problems in the macro sense. Just like the logs falling over there. I wasn't standing right here loading the logs into the cart. I was standing back here because I knew that the potential that was there to have logs fall. I've never had the whole wall fall out, but I've had logs fall in a weakened position, so I'm aware of that. So part of my plan was, don't stand right next to the pile and pull the log. So I start pulling the logs, this thing starts to give way, I take a step back, and they all fell right in front, right at my feet. If I would have stayed here and not been aware of the potential for the whole wall to come down, it could have broken my leg, or at least it chewed up my shins. There were probably 20 logs that came down, like that. Well, what do you think price is going to do? You think price is going to give you time to think? It's not. And so you need to be aware of potentially what could happen, so you could already have a solution in mind that doesn't give you conflict psychologically about the trade. Oh God, I'm going to buy it. It's running negative and I'm lost $400. Okay, take the $400 loss, because it can go to 4,000 just like that. Trading 3 lots. I had big losses on 3 lots because I didn't want to give it up. I don't get hurt. Well, I get hurt, but I don't get hurt too bad in relationship to the size of the bank that I take. So that at the end of the year, I'll have a far better percentage return against my money than I would have had, for example, in real estate. I was in real estate investment for 40 years. I know about risk management, and I know how you have to manage this stuff. I've also played a lot of poker in my life. You know, geez, I had a guy comment on one of my videos the other day about, oh, you're just gambling. You know what the fuck you're talking about. There's a difference between taking a risk and assuming a risk. And if you don't know those differences, then everything's a gamble to you. Getting out of bed in the morning is a gamble. Oh, God. Oh, there's so many people on YouTube that are big hat and no cattle. They have no idea what they're talking about. And that's why I don't have a very big viewership, because I tell it like it is, from experience and from a theoretical background, And I talk about it. I don't show charts and diagrams and all that other kind of crap, because if you can't visualize what I'm saying, what good is it? You shouldn't be trading if you can't visualize. In any event, we've gone through the entry part, we've gone through the building part of the stage, and now you're into this position management phase where you've got a runner. A runner is where you've got a price that you've entered, it's gone in your favor, you might have built a little bit on top of it, you might have gone into a stage, and it's hit the profit target where you hoped the profit would go, but it had enough momentum behind it, and I've done a lot of videos on that before, but it had a lot of momentum behind it so that you stayed with the trade and let it go past the profit target. And as soon as it goes past the profit target, I call that a runner. Now what do you do about where you set your stop? Or if you're not setting your stops, where's your pain threshold? Does that pain threshold become a pip value or does it become a dollar value? Depends on the size of your account. If you're trading all in, all out, and you got a runner, it's a pip value. If you're trading multiple lots in building and staging and all that other stuff, and you have a large account, it becomes a dollar instead of a pip value. The rule stays the same, it's just when you do it and based on what criteria you're going to use against that. But you have this price that has gone through those particular stages or steps, and we're going to kind of talk about that. It's a price that's gone beyond your profit target, which means it's different than if you're an all-in, all-out trader coming out at your profit target. You need to let that profit run. Well, how far do you let it run until you adjust your stop? Where do you bring your stop up to? How do you account for the fact that wherever your stop is, the average price of your position is still higher than that and closer to the current price? How do you balance that out? And how do you define, number one, when that price may be turning? And that's all you can do is come to a probabilistic estimate of when that price is beginning to trade. You don't know when it's going to happen, so you gotta look at that. I look at it down on a 1 minute chart. Sometimes I go to a 5-second chart. I understand there's too much noise down there, but from that noise, because price action is fractal, and if you don't know what fractal is, look it up. From a proportional standpoint, what's going on that 5-second chart is going to manifest itself pretty soon on a 1 minute chart, like in 12 seconds. And that 1 minute and that 5-second movement manifesting itself on a 1 minute chart, 4 minutes later is going to be a 5 minute movement. And so if I can catch that movement early, a 5-second period on a major pair might be an eighth of a pip or a quarter of a pip. So I let it go 5 bars, and I've got let's say 2 pips, and it's going, and maybe the short MA is crossed over the long on a turn. I see that the turns go for maybe 20 bars before maybe the turn reverses on maybe a 13 period moving average. And so you take the 13 and you say 13 times 5 seconds is so many seconds is so many minutes, and that could turn out to be 10 or 12 pips if I wait that long. This is giving me the signal now, and so maybe that's when I want to get out. But you have to balance your emotional connection to that trade because you believe in that trade. That's why you took it, and it's working and it's going in your favor. So you have a higher belief standpoint. So when that price begins to turn on you, it goes against your belief system, and you're going to hang on to that. We always hang on to our losers more than we let the price go ahead. I do that. I'm horribly deficient at that. But my trading is a little bit different. My bank size is a little bit different, so that if it does go against me radically, I got to jump out way out to maybe the 1 hour chart because I trade on a 5 minute. I won't jump to the 1 hour, I'll jump out to the 4 hour, and I'll look and see what's going on in the real big picture, and I'll go, my real risk here might be $2,000. Am I willing to take that $2,000 risk in proportion to the size of the bank that I have trading and what I can make on average on a daily type basis, either whether that's the number of days that I particularly trade or simply my gross profits divided by the number of days that were possible in trading. How many days will it take me to make up that $2,000? If that isn't a high differential, I'll take that chance. I may go to 4,000. And what happens a lot of times is that all of a sudden there'll be a friggin' spike in the price, and it'll go 20 pips, just like, you've been in there, you know that happens. So now I'm 40 pips out. I got stuck. And you go out to the daily chart. Where am I? Where am I in relationship to what's going on? What's the price action going? And so those are the considerations that your rules have to have for you so that you're not trying to do these calculations in real time. That's why it's so important for you when you're learning the trading process is to learn the correct mechanics of managing a position. You have to learn that. Once you learn those mechanics, then you can build your rules. You can't build your rules without mechanics, and you can't build your rules without real-time metrics. That's what you need to do. However, the point of the video is my rules cover the scenarios of exit methodology when I'm in the entry stage, when I'm in the building stage, and when I've got a price runner. And those rules that I have in those different phases of the life cycle of the currency position are extensible and cover me as far as how much risk I'm going to accept at that point by having the price turn against me. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.